Welcome to Target Professional Consults. Today we are going to look at one of the standards, the IAS. Please, if you have not subscribed, kindly subscribe and please partake in the drops, the question solving stage. Good. Today we are going to look at one of the interesting standards called IAS 20. That is government grants, and disclosure of government assistance. Good. So today's edition will look at government grants and disclosure of what? Government assistance. Now, we said that to clear every topic or every standard, we need to go through 5 items. One, the objective. And the scope. That's what we're going to look out for. Two, look out for basic definition. Definition of some things. Then three, recognition criteria possible. 4, measurement basis. Then 5, disclosure requirement. These are the issues we're going to look at for. So let's start with the objective and scope. As we know that the objective of every standard is to prescribe the correct accounting treatment of that standard. So here the objective of IAS 20 is to prescribe the correct treatment of what? Government grants. Good. Government grants. Good. So to describe the correct treatment of what? Government grants and disclosure of the government assistance. That's the objective. Good. Now the scope, it covers all grants except the following. Good. So I'll take this section off and leave the exception. Good. Great. Now let's look at the exception. Now it said that the IAS 20 government grants does not cover the following items. So item number 1 that the IAS 20 does not cover is government assistance given in the form of what? Tax breaks or tax concessions. So exception 1, we will talk about government assistance. So government assistance in the form of what? Tax breaks. Tax breaks. Or tax concessions. Tax concessions. Great. So basically, That is it. So any government assistance in the form of tax breaks, maybe concessional period within 5 years, your tax is different within 5 years, you're not paying tax free zone entry. All of these they are government assistance. But IAS 20 does not cover that. Good. Now let's look at the second item that the IAS 20 does not cover or does not treat. Good. Now, government acting as part owner of an entity. Government acting as what part owner, part owner. Good. So if the government is acting as a part owner of that entity, then it means that any amount or any grant the government gives to that entity is deemed as what? As a finance, source of finance, because you're a part owner, you are an investor, so you can't give grants. Good. So basically, that is it. Then also talks about the grants covered in IAS 41, agriculture produce. So you can also talk about three grants covered in what IAS 41. Good. So that's the third one. Then we are done. Good. So basically, we are done with the scope of IAS 20. Now let's go straight and treat the basic definition of some terms. Good. Now let's look at the definition of some terms stated in the standard. So definition of some terms stated in the standard. Good. So we are going to list the terms and provide basic definition or basic understanding of that term. Good. So the first on the list is government. You should know government is, so that's the first thing we're going to look at for. One thing number one, government. Government. Because IS 20 talks about government grants. So we should know who a government is, what we are referring to as the government. Is it the nations, states, or nationals? Good. Now, when we mention government in IS 20, it talks about the government itself, meaning the central government and its agencies. One is made up of what? The government itself, the government agencies, so government agencies, good, and similar bodies, and what? Finally, and similar bodies, both local and international or national. So the government that we are referring to can be what? International body. Good. That's World Health Organization, UNESCO, and then the other giant international bodies. They can also refer to as what? Government in the context of what? Government grants. How we get it? Good. Or any agency, both national or international. Good. We are done with the government. So now we know. So that when you receive the funds from a grant from the government or a grant from international body, such as what? World Health Organization. Also receive a grant from the World Bank, UNESCO, USAID, good, and the National AIDS Commission. All these people, according to, or all these institutions, according to IAS 20, they qualify to the word government. So if World Health Organization gives or awards you a grant of, let's say, $5 million, then it qualifies to be what accounted for as what government grants, even though World Health Organization is not a country. Good. So the government you are referring to is not a country, but it involves of what country or any agency or similar bodies, both international, national, or local. Good. So basically, that is it. Now, let's the next. Let's go to the next term. So we're going to define all the things stated in IAS 20, then you can understand what it is. Now let's go to government assistance. Government assistance. Government assistance. Good. Government assistance are supports or actions by the government designed to provide economic benefits. So they are supports or actions designed by the government to provide economic resources, economic benefits. So let's take economic benefits. So they are actions or supports by the government and by the government designed to, to provide economic benefits, provide economic provide economic benefits specifically to an entity or range of entities under qualifying or under certain criteria. Good. So in short, government assistance just refer to the supports, or actions designed by the government to provide economic benefits, to provide what great. Now, with the government assistance, is to a specific entity or range of what entity. So the benefit must move toward to a specific entity, to a specific entity, a specific entity, or range of entities, qualifying under certain criteria. But I like that qualifying under certain criteria, or for a return of what condition. Yes, there's no free support. Why the government is not supporting everybody, by supporting certain sector? Good. So qualifying under certain criteria. or certain condition for a return of what condition, because there's no free chop anywhere. Government will not just stand up and supporting anybody at all. No, a certain criteria. So for instance, when you come to Ghana, our government is in support of planting for food and job, and then one district, one factory. Good. So that's a criteria. Good. So and then to a specific entity under certain criteria. So specific entity under certain criteria. Good. Under certain criteria. Great. So under certain criteria. That is government assistance. And let me give you examples of government assistance. Let's assume that you want to produce drugs and you need license. And usually your license will take 6 months before you can obtain a license to produce a drug in the country. But if government want to assist you, if drug manufacturing is in the heart of the government, then the government is okay. Out of the 6 months, just use 2 weeks to obtain the license. There's something that you have to use 6 months to obtain with the help of the government instructions, with the help of government intervention, or with the help of government support. You are using 2 weeks. That is government assistance. Good. Example 2. Let's assume that we are local producers of rice. Yes. Now the government can support our business by imposing or restricting the importation of rice into the country. So when the government ban importation of rice, the government is indirectly supporting us, assisting our business to grow. That is what government assistance. Great. Now we understand government assistance. These are the terms mentioned in it. Good. So the government assistance is just providing economic benefits. Good. Now let's move on to the next step. Put that in the next step. Now, once we are done with government assistance, we can also talk about government grants. Government grants. Now, what is government grants? Government grants. Government grants. Now, government grants refers to assistance by government in the form of what? Transfer of economic resources. Transfer of what? Resources. So the underlying for government grant is assistance in the form of what? Transfer of resources. So anytime government transfer resources to the entity, that is the government grant. That one too, it does not come free. No, that one have a strict condition. Good. So transfer of resources to entity or to an entity in the return for past or future compliance with certain conditions. So transfer of resources or a return of all compliance of future or past conditions. So there's no free job anywhere. So transfer of resources From who? The government towards the entity, government to entity, for a return of what? Condition, compliance with what? With certain condition. So the return of what? Compliance, 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 good, with certain condition. Good. So it means that the grants that the government will give it to us come with certain conditions. So let me take the full definition again. The government assistance, so government grants. So the government grant refers to assistance made by the government in the form of transfer of resources to an entity in return for past or future compliance with certain conditions. Good. That's good. Now, there are two types of government grants. Let's look at that one too. The type of government grant. We have grants related to assets or the grant related to assets. Good. So grants related to assets. That is it. Okay, now let me cite the difference between the government grant and government assistance. With grants, with grants is a provision of resources. Here you give money, you give something. The government will move some resources from their coverage to the entity. So, so with the grant, there might be a transfer of resources from the government to the entity. That is grant. But with assistance, just a mere support that you are supporting the guy. You are just using your authority to help the guy. Good. So that is the government assistance. Good. So it means that here you can transfer resources such as what? Such as funds, cash, or assets, and other forms of what? Resource. You are done. That's the government grant. So we have grant related to what? Assets. Grant related to assets. So with this, government grant rules primary condition is that an entity qualifying for them purchase or constructs or otherwise acquired non-current assets. So they are grants that award to entity to acquired non-current assets. To acquired word to acquired or construct non-current assets. Yeah, that is grants related to assets. So government giving you funds or supporting you in acquisition of what? Your non-current asset. It's qualified to be part of what? Grants. Great. Then we go to grants related to income. Grants related to income. We call this capital grant and revenue grant. That's other name. Capital grants and area grants related income. We call it revenue grants. Okay. Now, with the grant related to income, in fact, it's all grants other than those related to the non-current assets. Now, most of these grants are to cater for your operating costs. So government we thought, okay, employ fresh graduates so that each and every year, so that for a 3-year period, I will give you $70,000. That is, this grant is what to cater for wages and salary of the entity. So it will be best described as what? As revenue grants. Because revenue grants or grants related to income, they are the grant that the government award to entities to cater for their operating costs. And cater for their operating costs. Good. Now let's look at the last item. Then we are done with the terms. So the last term will be the forgivable loans. Forgivable loans. So forgivable loans. Good. Forgivable loans. Forgivable loans. Good. Now, forgivable loans, they are loans that part of them or the entire loan can be what? Forgiven based on certain conditions. So part of the loan which can be forgiven or the entire amount can also be forgiven. So that's the forgivable loans. Please, all of these you have to be aware of this. These are the terms stated in the IAS 20. Good. Now let's narrow down the basic definition. Let's go to the recognition. How do you record the grant? On what basis? That's the recognition criteria. Good. Good. Now before I move on to the recognition of government grants, the last thing that I'll define, you also have what you call the non-monetary grants, and here it must be at fair value, non-monetary. If the government supply other resources or resources other than money or cash items, then it must be valued at what? Fair value. Good. And let's go to the recognition of government grants. And how do we record it? All the elements have a recognition criteria. Great. Now here, the standard specifically states that an entity should not recognize government grants until it has what? Reasonable assurance that, so before you record government grant, these are the conditions. There must be a reasonable assurance that, so first, there must be a reasonable assurance that two things. One, the entity will comply with any condition attached to the grants. So the entity will do what? Will comply. The entity will comply with any condition, any condition attached to the grants, any condition attached to the grant. And the second one, that one is very important. The entity will actually receive the grant. The entity will actually receive the grant or the money. Here. No, it must be the grants. Good, the grants. So that is the condition. So before you record grants in your books, these two conditions must be in place. One, you should have a full assurance that these grants that the government is awarding, I will be able to satisfy all the conditions, and this money or this grant will also be received or paid to me. That is the condition. Now, this is coming from where? The paragraph 7 of the grant. It comes from paragraph 7. If you move down to paragraph 8 of the IAS 20, it will state that even if the grant has been received, this does not prove that the condition attached to the grant have been or will be fulfilled. So even if they give me the money, that does not mean that you are going to fulfill the condition. The condition will be fulfilled in the future dates, or sometimes they will allow you to fulfill the condition before they would hand over the resource to you or the grant. Good. Good. Now, in the case of forgivable loans, it must be accounted for the same way as we account for the government grants. So forgivable loans must be accounted for the same way as well the government grants. Good. Now let's look at the presentation of grants and the measurement of grants. Presentation of grants. So I'll start with the grants related to income. So that's revenue grant. So presentation of revenue grant. So presentation of revenue grant. How do you present revenue grants? Revenue grants. Now with the revenue grants, the standards permits two treatments. The presentation. The standard permit two treatments. Don't forget that the presentation is a bit different from measuring. Measuring is getting the actual value of the grant, and the presentation is where exactly do you place it in the financial statement. That is a presentation. Good. So now we have two acceptable method by the IAS 20. Great. So the methods are, first, we have the separate credits method. The separate credit method or the credit method, the income credit method, the income credit method, income credit method. So this is income. credit. Education number two. Here, the salary is sent to other income. Other income. So here, the grants will be on its own, and then the expenses will be on its own. Then the second approach or method two given to us by IAS 20 is to deduct it from the related expense. Deduct it from where related expense. Deduct from related expense. From related expense. Good. Alright. These grants relate to what expenses and relate to the operating cost. So what do? You have two ways of presenting it. But you don't forget that if the condition has not been satisfied, you only recognize it to the tune of what? To the tune of good, the proportion that you have what? Satisfied. Great. So let's cite small example here. Small example. But before the example, let me explain a certain item. Now these are two different views. Two different views we have here. Now some will argue definitely that offsetting income and expenses in the statement performance is not good practice. Others too will say, okay, well, because of matching concept, we have to match them and then net it off and get a difference. Good. Now all these two approach or these two methods are what acceptable. Great. But just that now let's look at this. Here we are saying that without offsetting is not good. Deducting is not good. But we are saying that without that expense, that grant will not be what received. So therefore, let's net it or let's offset it. So that's the deduction from where the related expense. So assume that your wages and salaries, so let's say 360,000 for that year, and government award a grant of 80,000 cents. So here, I'll let the grant of 80,000 to this. Whatever I get, that will be the wages and salary for that particular year. And that will give us 280,000. So this is what we mean by the deduction from the related expense. Under the first approach, you record the 80,000 in other income and your wages and salary will stand at what? Will stand at 360,000 in the books. Well done. Good. Now let me cite marriage treatment. This is the presentation. Now, how do you get the values? I have two approaches that I normally use. When we are solving the question, kindly join us for you to get this to go very well. This is the tuition phase, question solving. Now, let's assume that government award us $50,000. So $50,000 for a period of 3 years. for a period of 3 years. So that we should employ a certain number of local staff for a period of 3 years. So we should employ 60,000. So $50,000 for 60 local staff for a period of 3 years. So let's now we have received these grants and we are certain that you will fulfill the condition. Let's assume that year one, year two, year three, these are the number of, of staff that we employ. In fact, we did well, we employed 30 and we employed 20 and the remaining 10 was employed in year three. So what will be the equivalent grants? The entire grant given to us is $50,000. So all what we have to do is we have to apportion it time by time because we cannot record the entire 50,000 as a grant for that year. No, set this grant as a what? As a liability, and every year a portion must be released to the income statement, and then we are done. Good. So if the entire staff must be 60 and we employ 30, so to what? 30 divided by the 60 times the $50,000. Then you will get, so let's quickly calculate. And this one will give us 25,000. So 25,000. Good. 25,000. Then year two, they employ 20,000. They employ 20 employees. That will give us the 20 out of 60 times $50,000. So finally, to give us 50, 5 divided by 3. That's 16,667. 16,667. Automatically, it's going to give us 3,333. So these are the points that we are going to work next. Now, how would the P&L look like if we're using the income credit approach? Assume that the wages and salary tool is here. I'm giving us the company's wages and salaries and in here. Wages and salaries for the year 1, 2, and 3. And the wages and salary is in cities, which is $1,000. The next, which is 70,000, 55,000, and 75,000. So, how do you present this? So, I'll do the income credit approach. With the income credit approach, under the income credit approach, I will go to the P&L. I will show my operating cost of wages and salary of what of the full amount. So here we have year 1, year 2, year 3. So year 1, the wages and salary is 70,000. Year 2 is what 65,000, then year 3 is 75. And I'll go to other income. Then write grants. So the first year, they should keep in 25,000, I will go 25,000. Then I'll go 16,000, just and then 3,000. So that is the year. This is how the income credit approach will look like. They shouldn't forget that there will be financial statement or balance sheet extracts. Good. Now let's see. The deductive approach. The deductive approach. Found year 1, year 2, and year 3. For the deductive approach, we just have to show wages value of. We just have to show the wages and value of the net amount. So net term of 70 against 25,000. That gives us 45,000. Then 65 against 16,000. 666 to put it down. And that's year 3. Good. So that's the end of the income and deductive method for that of the government grants. Now let's go to presentation of capital grants. So capital grant. Now capital grant refers to grants relating to assets or non-current assets. Good. And then there are two treatments of two preferred presentation. Here too, yes, we have deductive approach and then the deferred credit or deferred income approach. Good. Good. So we have deferred income. Good. So with the deductive approach, all what you're saying is deduct the entire grant from the cost of the assets and depreciate the remaining balance. So let's write something small under deductive. So here deduct the amount of the grant from the original cost of the asset, original cost of the assets, original cost of the assets, and depreciate the remaining balance. And depreciate the remaining balance. That is the deductive approach. We are done. Good. Now let's go to the deferred income. With the deferred income, as the name suggests, the grant will be on its own, then the asset will be on its own. So the grant will be depreciated, which we refer to as what? Amortized. The grant have to be amortized over the useful life of the asset. And here usually it must move with the policy or the method of depreciation. Good. So deducting just subtract the entire loan from the cost of the asset and depreciate the remaining balance. Now let's go to the deferred income. So the deferred income, the entire grant is amortized. So grant is amortized over the useful life. Now, and then the asset is being depreciated on the original cost. You depreciate the asset on original cost. Good. Depreciate the asset on original cost. So here, using the method of calculating depreciation, the depreciation method must be applied here. So if you depreciate your asset on straight line over 5 years, then the grant must be amortized over 5-year period. If you depreciate your assets on reducing balance method, the grant must be amortized on reducing balance method. We are done. So how you amortize the grant must correspond with your depreciation of the asset. We are done. So now let me back with the illustration. So I'll pick a question. Great. In fact, I'll do that at the question solving stage. So kindly join us at the question solving stage for you to grab the gist ones better. Now let me go to the last stage for the last section of this topic so that you join us at the question solving. Question. Now repayment of grants. That's the last aspect. Repayment of grants. Now, sometimes if the entity fail to comply with the condition, the grant condition, government may ask you to repay the grant. So now we have it for related to income. So grant related to income. How do you do the accounting entry? So related to income, how do you perform the accounting treatments? Or what are the accounting treatments to record repayment if it is a revenue grant? Good. So if the grant relates to income and then asked to repay back, then first any unamortized deferred income set in respect of the grant and any excess should be recorded immediately as what expense. So here what you are saying is this: if you want to repay back the accounting treatment is this, just set off, apply it against any unamortized deferred account. So, or deferred income. Now, what they are going to pay must be the balance left because you are using the related to income. If the balance left is around good. Now, any balance left in the grant account, that is the variability, we take it off. So assume that left with a balance of 300,000, 300,000. That's the balance left, 300,000 dollars. But the government says we should pay 20% of the grant, which represents what, $600. That means there's an excess here. The excess must be expense. So the repayment must be against the unamortized. That is the 300. Any excess must be reported in the income statement as what? As an expense. We are done. How do you do the repayment of grants related to assets? Good. So repayment of a grant related to assets. How do you do that one too? We are done with this. So related to assets. Related to assets. Good. Great. Now the repayment of grant relating to assets. All you have to do is this. Now first, increase the carrying amount of the asset or reduce the deferred income balance. Any balance, reduce it by the amount repayable. Then the cumulative additional depreciation that would have been recognized in the date in the absence of the grant should immediately be recognized as what, as an expense. We are done. So this is how far the good Lord will bring us. Kindly subscribe if you have not done that, and you can join us when we are solving the question. We are done with IAS 20. Thank you very much.